Hey, this is Sasha. Thanks for joining me in today's video. What we're going to do is cover at the money call options versus out of the money call options when it comes to trading covered calls. And that's what we're going to go ahead and cover. Now, if you want to learn a lot more about this, check out the website. There's a lot of great articles and posts about that. You can also really get in more insight on covered calls just by going to the courses section. And if you want to work one-on-one, you can also do that. But here's the covered calls for monthly income course. And you can also check out the coaching where I work with people showing them how to do this. Okay, so let's first get started I'm going to go on paper. So I'm going to show you some insight on how this looks when it comes to trading covered calls. So really what it comes down to when you're doing this covered call strategy is, let's say you own 500 shares of stock. Well, this shares is actually the delta. So let's just pretend 500 shares, 500 delta. Okay, 100 shares, 100 delta. So in this case, if we got 500 delta or 500 shares of the stock, we're kind of traveling this way for a profit. So here's our profit, okay, up or down. And here's the price of the stock, okay? Now, what you're doing when you sell a covered call is actually you're selling against it. So you're saying, hey, I'm willing to sell that stock at this point. And if you're willing to sell it at this point, well, now you're looking for a negative delta that you're selling. So the call itself actually looks like this, wanting it to go down. But together, they construct this strategy. And all it does is really takes your 500 shares to maybe like 450 or so. Or if you've got less of a delta, it might be, instead of 450, it might be 490. So you're kind of trimming your position. So this way, you know, stock goes up $1 when you have 500 shares. Well, you make $500, okay? But if you only have 450, well, in that case, that you'll make 450 if it goes up $1. That's what it tells you. Now, if it goes down, you lose less in this case, because when you have less delta, less 450, you lose only 450 instead of 500. So let's look at how this applies in a practical application. So as we go in and let's say we've got GoDaddy here. All right, awesome, GoDaddy. Okay, we've got 500 shares, boom, 500 delta, 500 shares, 500 delta, 505 shares, 505 delta. Perfect, right? So let's say we've got 500 delta. Okay, stock goes up $1 or down $1. Let's set that up. All right, so we're going to go ahead here. Let's say stock goes up $1, stock goes down $1. Okay, now what do we make? Well, up $1, down $1. So we make $500, lose $500, okay? Because right now we're isolating at about a $45 here. So let's reset that. There we go. So there you go. 500, down 500, up $1, down $1. Okay, up $2, down $2. Well, $1,000. Okay. All right. So now let's take a look at this and start adding some calls to it. So we're in GoDaddy. Let's say we go 15 days here. Well, I could go in. Here's the delta, by the way. Sell this one, this one, this one, this one. Now here I only make $60. Here's $100. Here's $200. Let's go into this one right here, and I'll just show you the one. Actually, let's go at the money. Sell this one. We'll sell a single. Analyze that trade. We'll sell 5 of them. We've got 500 shares. We'll sell 5 of them. Okay. So what you're seeing here is now if it goes up, we flatline because we're willing to get rid of that stock just a little bit higher. But we really cut our delta 251 and we make $175 per contract. In total, that'll be $875. Okay. So we cut to 250 delta. Now, if we go further out, right now, this is at the money, okay, because that's our 0 point. There's plus $1, minus $1. If we now go further out, let's say we go to the 80, okay, we only make 25 cents. We can make more money from the stock appreciation, but our delta, look at that, 217. Notice, or sorry, 417. Notice the difference, okay? 250 versus 416. So the question is do you want more stock appreciation? Do you believe that stock will keep heading higher? Or do you think it's going to pull back? If it's going to pull back, well, you want to cut the deltas as much as possible. Well, then I'll go down to 75. And now I'm only going to lose $250 for every dollar move down. However, if I go to this one, I'm going to lose $526 when it goes down $1. So that's a big of the difference, right? It's thinking about the losses. So here, 75, I'm going to lose 341. If I go to the 80 strike, I'm going to lose 526. So that's the big thing. So if you want, in summary, if you want more protection, you go closer in to where the current price is. If you want more stock appreciation, you think the stock's going to keep going higher, go further away or out of the money. If you want more protection, go in the money. Okay, so that's kind of the general rule. But also, as a caveat or side note, tangent here, when the stock has headed higher, really exploded to the upside, it's probably good to protect yourself and get closer at the money or even slightly in the money. When the stock's pulled back quite a bit, you might not even want to sell any covered call because you're looking for an expected move higher or go further out, in other words. Now, I know it may feel like, ooh, you're panicky because it's selling against you. But remember, in 20, 30 days, things could be different. And that's the way this operates. All right, so I hope that helps. I definitely encourage you to check out the courses, especially covered calls, if that's what you're interested in, is trading covered calls and really coaching for covered calls. If you were interested in that for a couple of months, we work together every single week. So anyway, thank you so much for joining me. Enjoy the rest of the week ahead, and I will see you on the next video. Take care.